This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Welcome back to Candle Logic Trading, where we read the market and own the trade. In our last lesson, you learned what a candlestick actually is: the open, the close, the high, the low, and the story each candle tells. If you haven't watched that one yet, go back and start there, because today we build directly on it. Here's the truth most beginners never hear: you don't need to memorize 100 patterns to trade well. You need to master a handful of high-value ones and understand why they work. So today, we're breaking down the 5 most powerful single candlestick patterns. Just one candle each. No complicated multi-bar setups. 5 candles that, once you can spot them, will change the way you look at every chart. Let's get into it. Fast refresher, because everything today depends on it. Every candle has 2 parts. The thick part is the body. That's the distance between the open and the close. The thin lines above and below are the wicks, sometimes called shadows. Those show the high and the low that price reached before settling. A green candle means price closed higher than it opened. Buyers were in control. A red candle means price closed lower than it opened. Sellers were in control. Here's the key idea for this entire lesson. The body tells you who won. The wicks tell you who fought back. Hold on to that. Every pattern we cover is just a different battle between buyers and sellers, and the candle shows you who's winning. Pattern number 1, the hammer. Picture a market that's been falling. Sellers are confident. Price is dropping candle after candle. Then one candle forms with a small body up near the top and a long wick stretching down below it, at least twice the length of the body. Here's what that long lower wick is telling you. During that candle, sellers pushed price way down, but before it closed, buyers stepped in hard and shoved it all the way back up. That long tail is the footprint of buyers overpowering sellers. It's rejection. The market tried to go lower and got rejected. When a hammer appears after a clear downtrend, it's one of the earliest signals that the selling pressure is drying up and a reversal to the upside could be coming. The color of the body matters less than the shape, but a green hammer is slightly stronger than a red one. One rule to burn into your memory: a hammer only means something after a downtrend. The same shape in the middle of nowhere is just noise. Context is everything. Pattern number 2, the shooting star. This one is the hammer's mirror image. Now, picture a market that's been rising. Buyers are in control, price is climbing. Then a candle forms with a small body down near the bottom and a long wick stretching up above it. That long upper wick is the story. Buyers pushed price up to a new high during the candle, but by the close, sellers slammed it back down. The buyers ran out of steam and got rejected at the top. That's exhaustion. When a shooting star shows up after an uptrend, it's a warning that the buyers may be losing control and a move to the downside could be next. Long wick on top, small body at the bottom, appearing after a rally. That's your shooting star. Same principle as the hammer, flipped. The wick shows you where price got rejected. Up top means sellers are stepping in. Before we continue, quick shout out to today's sponsor, ResumeZenith. If you're trading to build a better future, you still need to handle the present. ResumeZenith is the site I personally recommend to anyone job hunting or leveling up their career. Clean, professional resumes built fast. Check them out at ResumeZenith.com. Links in the description. And if you're finding this lesson valuable, make sure you hit that like button, subscribe to the channel, and turn on the notification bell. We drop new lessons every Sunday, Tuesday, and Thursday, and you don't want to miss what's coming next. Alright, back to the charts. We've got 3 more patterns, and the next one is all about pure conviction. Pattern number 3, the Marubozu. This one's easy to spot because it's the simplest shape of them all, a big, full body with little to no wick on either end. The name comes from a Japanese word meaning bald because the candle has no hair, no wicks. Think about what that means. A bullish Marubozu, a big green candle with no wicks, means price opened at the low and buyers drove it straight up to close at the high without ever giving ground. That's total control, pure conviction, no hesitation, no pushback. A bearish Marubozu is the opposite. A big red candle, opened at the high, sold straight down to close at the low. Sellers dominated from open to close. Unlike the hammer and shooting star, the Marubozu isn't mainly a reversal signal. It's a continuation and strength signal. When you see one, it tells you the side in control is fully committed, and the current move likely has momentum behind it. When a strong Marubozu prints in the direction of the trend, it's confirmation that the move has real force. Pattern number 4, the Doji. A Doji forms when price opens and closes at almost exactly the same level. The body is tiny, basically a thin horizontal line, with wicks extending above and below. It looks like a cross or a plus sign. Here's what it means: total indecision. Buyers and sellers fought all candle long, and neither one won. Price ended right back where it started. It's a standoff. Why does that matter? Because indecision is most powerful at the end of a strong move. If the market's been trending hard in one direction and suddenly a doji appears, it's telling you the momentum has stalled. The side that was winning has lost its grip. That doesn't guarantee a reversal, but it's a signal to pay attention, tighten up, and wait for confirmation from the next candle. A doji in the middle of a quiet, choppy market? Not very meaningful. A doji after a big extended run? That's the market whispering that something may be about to change. Pattern number 5, the spinning top. The spinning top is the doji's close cousin. It has a small body, but unlike the doji, the body is visible, not just a line, with wicks of roughly equal length on both the top and the bottom. That shape tells you buyers pushed up, sellers pushed down, and when the dust settled, the candle closed near where it opened with only a small net move. It's weakening momentum. Neither side could take firm control. Like the doji, a spinning top is most useful in context. After a strong trend, a spinning top signals that the dominant side is tiring and the trend may be running out of gas. It's not a screaming reversal signal on its own. It's a caution flag. It says, the tug of war is tightening up, so don't assume the trend just continues automatically. Master traders don't react to a single spinning top. They use it as an early heads up, then wait for the next candle to confirm the story. Let's tie all 5 together, because this is where it clicks. The hammer, long lower wick, appears after a downtrend. Buyers rejecting lower prices. Potential bullish reversal. The shooting star, long upper wick, appears after an uptrend. Sellers rejecting higher prices. Potential bearish reversal. The Marubozu, big body, no wicks, total conviction, strength and continuation. The doji, open equals close, across, pure indecision, momentum stalling. The spinning top, small body, wicks both sides, weakening momentum, caution. And here's the single most important lesson of the day. A candlestick pattern is never a signal by itself. Its power comes from where it appears. The same shape means something completely different at the top of a rally versus the middle of a quiet range. Location, trend, and context turn a shape into a signal. Don't trade a pattern just because you see it. Trade it because it's telling you a story that lines up with everything else on your chart. Here's your assignment before the next lesson. Open up a free TradingView chart, links in the description. Pick any stock or crypto you like and scroll back through the history. See how many of these 5 patterns you can spot and pay attention to where they showed up. Were they at the end of a trend, in the middle of a range? Training your eye is how this becomes second nature. And if you want this entire lesson as a clean, downloadable PDF to study from, including all 5 patterns and the charts, just drop your email over at candlelogictrading.com and we'll send it straight to you. In the next lesson, we take these building blocks further and start combining candles into full reversal patterns so you can spot the turn before it happens. You won't want to miss it. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. That's it for today. Read the market, own the trade. I'll see you in the next one.